We really saw financials outperform yesterday on the idea that we'll see less regulation under a Trump administration. We also saw Bitcoin move higher, also part of that Trump trade. Do you believe there's more legs in that rally? Is there more room for that to run? And if so, how would you play it?
Well, Frank. First of all, thank you so much for having me. It's great to see you, and it's great to be here on a day like today because markets are in full swing. You said it, markets broke a number of records yesterday. Trump trades are in full swing. There were definitely a number of winners coming from the election results. The ETF market, just by way of background, registered a post-election record. Yesterday, we saw about $22.2 billion of new money coming into the industry. And I want to remind everybody that the prior record was $4.95 billion in 2020. So record high, a lot of excitement in the market. There were a number of winners. You mentioned that the financials are really leaning in on the expectation of lesser regulation. Digital assets are also registering some all-time high with the Bitcoin increasing about 10% yesterday. But we also saw some positive flows in oil-related industries.
So Anna,
there is an
let me interrupt for a second. You gave us two ways to potentially play banks and Bitcoin. One is the KBE, well-known ETF. The other one is ticker DECO. It's a Galaxy Digital Asset Ecosystem ETF. So in your mind, as we look at those two, how much more upside could they potentially have now that we have, again, certainty that President-elect Trump will be taking the White House in January?
Yeah, so Frank, there is definitely room for upside. I don't think that what we saw yesterday is just a one-day phenomenon. Let's remember the uncertainty about banking regulation and Bitcoin, not so much about bank, but uncertainty about Bitcoin regulation. Trump, in one of his rallies, proclaimed himself as the new crypto king. And that in itself sent a very strong message to the crypto industry. So I don't believe that yesterday's news is just going to be just a one-off. I think it is the beginning of a trend. There are definitely products like HECO and DECO that I would keep watching because I think that the upside is.
And Anna, both of them up double digits week to date. We saw the big moves following the election. Tina, I want to come over to you. Some of this rally on Wall Street is due, as I mentioned, certainty. We know who's going to be in the White House. We know Republicans are going to control the Senate. Right now, there's some questions about who's going to take the House. So when you're talking to clients about their investments, is there a different outlook when we look at a possible red sweep versus a divided Congress?
Absolutely. I mean, as you know, Frank, historically, markets have preferred a divided Congress because it puts a brake on, complete free hand on policymaking. And I still think that a divided Congress would be the best outcome in this situation where Trump's policies are prompting clearly market euphoria, but also some concerns about how far he could go. Having said that, Frank, it is very much within the realm of possibility, if not probability, that there is a clean sweep for Republicans. And that is a result that we haven't seen in the United States for a very long time.
So when we're talking about that possible clean sweep, that scenario generally seen by, many different analysts and strategists, including J.P. Morgan, as raising bond yields significantly. In fact, J.P. Morgan out with a note just a short time ago saying that if there is a quote-unquote red sweep, they see the 10-year moving as much as 40 basis points higher. Does that change the investment outlook, at least for your clients, what sectors they may want to invest in and where they may want to put their money when it comes to equities compared to bonds or possibly corporates and things like that?
So my clients are global, and what we are cautioning them is that the market euphoria may last for weeks or months, but we also have to, accept that the market euphoria is at some point going to collide with the economic and geopolitical reality. The Trump tariffs on China, 60%, maybe a bargaining point, but certainly going to hurt a number of companies. And then the rate cutting cycle expectations are also going to be impacted. I talked to a lot of real estate investors, and we can see that that was one sector that didn't experience the same kind of positive momentum as others, and that's clearly on the back of expectations that the Fed is going to be ultimately concerned about the inflationary impact of some of Trump's policies.
All right. Anna, I'm coming back over to you. In addition to an election this week, of course, we have a Fed decision, widely expected to see a quarter basis point cut. You gave us two other plays. One of them is in the small cap space. That's an ETF ticker SPSM, and also an insurance ETF ticker KIE. Why are these two areas that you see as benefiting right now in this current environment? Is it based on the Fed cuts? Is it based on less regulation from the election? What's really the catalyst when it comes to these two in your mind?
Well, the catalyst is that we have not really heard anything during the campaign about the fiscal policy. There is this lingering concern about tariffs, and inflation is still going to be top of mind. So if you put all of these things together, you can see that there are certain asset classes and certain tickers that are going to be front and center in people's minds.